Okay, good morning, everyone, and welcome to our Tuesday Market Outlook session. My name is Prakash Vijayanath. I am an analyst here at Options Play, and today I will be walking you through how we are viewing the current markets. Just to let everyone know, Tony and his wife had their first child last Thursday, and the family is doing great, which is great news. Tony will be on paternity leave for the next 4 weeks, and I will be doing the market outlook sessions until then. So this week is going to be quite a big one with the Fed meeting over the next 2 days, which should provide some insight on where markets will be moving next. We know that there will very likely be a more hawkish tone with regards to what they will be doing with monetary policy. But the question is, how much of that has been priced into the markets and where do they head from here? So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So starting off with today, we'll be starting off with the major equity indices. We'll be highlighting some key levels and taking a look at some price action ahead of this Fed meeting. From there, we'll be moving on to fixed income, which has been fairly neutral over the past few weeks. But I think fixed income is where the volatility will be this week. So it'll be good to just take a look and highlight some of the key levels there. And we'll also be taking a look at some commodities. From there, we'll be looking at the sector performance and rotational model, highlighting what sectors are doing well relative to the market, what sectors are underperforming the market, and what you should be avoiding. From there, we'll be have a look at some of the subsectors of interest. And we'll end today's session with some bullish and bearish market movers. My name is Prakash Vijayanath. I'm an analyst here at Options Play, and I'm really excited to share with you today our thoughts and analysis on the current market. And starting off with the S&P 500, we've had so many headwinds for equities, slash GDP estimates in emerging markets, China, and even Europe now. We have labor shortages, supply chain constraints, inflation, tapering, the list goes on. Yet equities continue their grind higher, and that's largely been thanks to what has been a very good earnings season. Now, if you look at the price action here, we see quite a strong rally for the last few months and a significant pullback back to that 430, 425 level where price did find some support here for the S&P 500 and a strong bounce higher to all-time highs. And I'd say during this period here was where equities really started pricing in the fact that the Fed may be tapering and even at least one interest rate hike for 2022, which is why I do think that markets are so confident, trading at all-time highs for equities heading into this 2-day Fed meeting. Recently, we saw price did break above that 453 resistance level. It came back to retest it and it bounced higher with strong momentum here. So that for me is quite constructive of a move higher here for the S&P 500. And if we take a look at the NASDAQ 100, over the last couple of weeks, the NASDAQ 100 actually was slightly underperforming the S&P 500, but that case is starting to shift. We can see similar price action, a large rally here to the 382 resistance, significant pullback back to 350, finding support, and a strong move higher back to closing at all-time highs yesterday. Price action here is quite bullish. And for me, with big tech earnings behind us, which really was something that would have caused a lot of volatility for the NASDAQ 100 and may have even been a catalyst for a reversal lower from the 382 resistance level, we can see here was actually the catalyst to break above that major resistance level. And now I do see further upside here for the NASDAQ 100 as we continue into earnings season. Looking at small caps, now finally we're seeing some exciting price action, if I could say that. What we have here is a longer term neutral trend here for small caps. Major indices or the large and mega cap names were making new all-time highs. Small caps really weren't participating in that. And prices relatively range bound between that 234 to 10 range. But what we're seeing here more recently is very strong momentum, growing momentum to the upside here, and price posting higher lows, as you can see, and very much what I would say a breakout with strong volume all the way to all-time just shy of all-time highs here at 233. It looks like small caps may open a little bit higher, but the fact that there's strong volume yesterday, strong momentum, that for me tells me that there's a lot of evidence to support the thesis of small caps breaking out higher from current levels, which is fantastic news because it means that they are now participating in the broader rally that we are seeing with the major indices like the S&P 500 and the Nasdaq 100, and that's the first time really this year that they are doing that. So definitely more upside here should that 234 level be broken for small caps. Value versus growth. So there's nothing that interesting happening in this graph, but the reason I want to show you this graph was because, with all these headwinds, it's hard to imagine that momentum will continue. And I really do think that it'll be next earnings season where we may see a catalyst and we may see some of the consequences to those headwinds I mentioned earlier, like problems with inventory, supply side constraints. There's quite a few headwinds, right? So if you look at the S&P 500, and if you just take a step back and you look at the performance over the last 2 years, this year it's up 23% year to date, and last year it was over 16%. So consider the fact that over the last 20 years, the S&P 500 has only returned just over 7% per year. There really is a case here to be made for maybe not a full-on reversal, but definitely a slowdown to what has been a very bullish rally for the major indices, for the S&P 500 and the Nasdaq 100. And for me, this does not necessarily mean that there won't be any opportunities, right? Because as monetary policy starts to tighten, investors will look to value stocks over growth. And that's why I wanted to highlight this graph, because it really does, I think it'll be an important metric, maybe not right now, or maybe not even in the next month or two, but definitely heading into 2022, I think this will be a very important metric to see when investors start shifting from focusing on growth stocks to maybe more value stocks that are more stable and are yielding higher dividends. So, and as an investor, you really want to ask yourself, should I be adjusting my portfolio holdings accordingly as monetary policy starts to tighten and we enter growing interest rate environments? So if you look at bonds, bonds I mentioned earlier, expect a lot more volatility this week because of the Fed meeting. And what we did see here was this break below 145 a couple of weeks ago, and a bit of neutral movement here, nothing much to really comment on. And then over last week, price did break above that 145 level and came back to retest it and bounced higher. So, if you're looking at price action alone, there's a case to be made for a move higher here back to 152. But we know bonds are still relatively weak at the moment. So I do expect maybe the Fed meeting to provide a catalyst for break below this 145 level again, and maybe all the way down to 140. Definitely bonds would be the main focus here over the next 2 days, because I think equities have largely priced in maybe at least one interest rate hike for next year, which will be a headwind normally, but I do think that's been priced in. And that leads us to yields, which we saw this very strong rally all the way to 170 basis points in recent weeks. And then we see this immediate pullback, and yields are really consolidating ahead of the Fed meeting. They're not really able to break above that 160 basis point level over the last 2 days, rejecting it twice. And I think that, from here, depending on what happens over the next 2 days, we may see a move back higher, breaking about 170 basis points to maybe 175 basis points or so. or maybe a move back lower here to 140 basis points or so. When yields break out higher, that's normally that normally adds fuel for the banking stocks. So there you don't want to maybe look at some financial names, but when they move lower, that does provide a significant headwind for those names as well. And we can see here that momentum is starting to decelerate, but again, expect a lot of volatility here for yields over the next few days. And next we have the US dollar currency index, which you can see here a very significant break above that 93.5 level a few weeks ago. This level provided resistance for almost a year now, maybe actually more than a year. And since then, price has somewhat been consolidating, retesting that level. It has formed a base now at 93.5. There was a false breakout a few days ago, and then price did bounce back with strong momentum. So for me, this is pretty constructive for a move higher in the US dollar index. And that leads us to gold. So obviously gold has a very inverse relationship with the US dollar. And all we can see here is a long-term bearish trend really for gold. And price has been very, very choppy over the last few months. It's been trading below the 171 resistance level and 160 support. And recently price did bounce high from support, but it didn't really bounce high with a lot of momentum. We can see a pullback in recent days and maybe a slight bounce higher. But should gold maybe grind higher to 171, I cannot see it really breaking above this level. And the reason for that is, back to the US dollar. I think the only scenario where I see gold breaking above 171 is if the 93.5 level breaks to the downside here for the US dollar. So I think that's quite unlikely. And should price rally all the way to 171, I think it provides a pretty good risk to reward bearish entry here for a move lower back to near 160 or so. So let's take a look at the sectors. Last week, we highlighted that there was strong performance in almost all of the sectors. We had 10 sectors in having bullish trend and one sector, communications, being the only one on a neutral trend. And this week, we pretty much see the same thing. 10 sectors are on bullish trends and communications still on the neutral trend. So not much has changed in that regard, but I have noticed some technical scores reducing for a few of the sectors, that has to do more with rotation in and out of some sectors. And here's a sector rotational graph. As we can see, we have 5 sectors in the improving and leading category and 6 sectors in the lagging and weakening category. Last week, it was the other way around. We had 6 in the improving and leading and 5 in the lagging and weakening category. So there is maybe some signs of narrowing leadership, but nothing to be concerned of right now. I think it'll only be concerning if that continues. And right now we can see some of the strong sectors here that are moving to the right towards the leading category. We have discretionary providing leadership, very strong relative strength against the market, as well as strong momentum. And we have technology and real estate here in the leading categories as well. But technology has been showing signs of weakening momentum. However, I do think that's more a bit of a pullback rather than a reversal. And we also have healthcare, which very strong momentum, growing relative strength relative to the market. And I do think that is indicative for a move back to that leading category soon, should that continue. Sectors to avoid. Well, according to this, we have communications, but I will be analyzing communications in a bit further. But we have communications and staples that on the lagging category, very weak relative strength and momentum. Bit of a pickup in momentum for staples, but nothing to really consider as a bullish signal. We have industrials as well that was in the leading category early last week even, and has moved now to was moving to the lagging category here on weak momentum and weak relative strength. And similar story with materials, which is in the weakening category, rotating out of the leading category. Okay, so looking at some sectors, communications. Now, I wanted to highlight communications. I know it's in the lagging category, but what we're seeing here is this reversal in price and a bit of a base formation at around $80 or so. Price is finding support at the $80 level, and we can see. I do think that momentum is starting to shift higher slightly. The price is definitely still consolidating, but I think once we see a breakout up around that $82 level or so, that would be constructive for a move higher back to 86 all-time highs, or maybe even further for the communications sector. But I think patience for this is required here, as price is definitely consolidating. Next, we have technology. Finally broke out to new all-time highs. We can see very similar graph to the Nasdaq 100 and S&P 500. Found resistance here at 160, pulled back significantly as yields were rising as well. And since then, price rallied with some strong momentum, growing momentum still above that 160 major resistance level. It came back to retest it intraday, rejected it, and that for me tells me that there is maybe a bit more upside here for technology. So I want to move on to some subsectors of interest that I have been looking at. And here we have KRE, which is a regional banking ETF. So very sensitive to higher yields, higher interest rates. And we can see that since yields quickly rose up, so did the price of KRE. It looked like it was breaking above that 73 resistance level. It did come back down, it pulled back, and it bounced higher now with strong momentum here, which does provide a better risk reward long opportunity here for KRE as momentum. Momentum looks good, looks to be picking up, and the pullback does provide a better, more comfortable bullish entry here for KRE. And I do expect further bullish price action here for this ETF. Next, we have the semiconductor ETF, SMH. So with all the new Metaverse announcements, and Facebook expected to grow its capital expenditure by 66% next year, semiconductors are really in a great position to benefit from that, and especially the names like Broadcom, Nvidia, AMD, and Marvell. I think the fundamentals look good for them based on Facebook's capex increase for 2022. So we look at the price action here for SMH, which it bounced higher from that 249, 250 support level with strong momentum, and it's breaking out to new all-time highs here. Momentum is still growing, and that tells me that price should break above this level, and I would look for maybe a retest, bullish price action near that 276 level for a further continuation higher for semiconductors. And I think SMH is a great play to get that broad-based exposure for semiconductors, which are traditionally higher beta and a lot more volatile. So moving on to some market movers, starting off with 3-point McMoran. We can see here price did pull back from all-time highs at 46 and remained somewhat neutral for the past few months. And what we can see here more recently is some strong momentum. Price has been flirting with that 38, 39 resistance level. It did look like it was breaking out. It was a bit of a false breakout, and price did not exactly reverse. You can see here over the last 3 days, it's closed higher than where it opened. So I think it's going to be retesting that level. And where we can see that it looks like pre-market, it's actually set to open higher than that around 39. So it'll be the price action for SBUX today would be quite interesting to see if it actually does manage to break above this level. And if it can stay above this level at the close, I do expect that continuation here of SBUX back to around $46 or so, back to the all-time high level. Next, we have DE. So DE recently broke above what I would consider a bit more of a minor resistance level at around 350, 355 or so. And it broke higher with strong momentum, good volume as well. So the momentum was negative, it's turning positive, it's turning bullish here. So that's for me constructive for a move higher. The fundamentals for DE look quite good. They have improving revenue acceleration, they have EPS acceleration. So this is really a case of where the technicals and the fundamentals are somewhat aligned for a move higher here for DE, especially when you consider it's been relatively range bound, right? So I do think there's a thesis to be made here for continuation of this bounce. And the fact that price did pull back at the end of yesterday does provide a good risk reward entry here for DE. Next, we have Oracle. So Oracle's has been one of those silently very bullish names since the pandemic drop. And what we can see here more recently there was a strong resistance level at 91. Price remained neutral for a couple of months, a few weeks or so. And then more recently, price did break above that level. It looked like it was heading to 100 and it has been pulling back. And I do think that should Oracle pull back further, back to the 91 level, it does provide a good risk to reward long opportunity should there be some price action to act as more confirmation, which does provide, and that provides a good opportunity here to gain bullish exposure for Oracle, maybe back to all-time highs or even to that 100 level. Okay, so SBUX, this is a bearish market mover. And what I see here in SBUX is almost a textbook head and shoulders pattern, right? So we have the left shoulder, head, right shoulder here. And then earnings was a catalyst that really made price break below that 110 neckline. And since then, price has come back to retest that level. It did reject it intraday, but during the end, price did rally back higher to near session highs. What I'd like to see here, even though it is a textbook head and shoulders pattern, what I'd like to see here is more bearish price action. And that would really help confirm or be a confirmatory tool here for a bearish trade. So SBUX definitely want to look at for today. Try to see if there's bearish price action, and that might provide some more evidence for a further move lower, maybe back to even $100, that support level there or so. So next we have Zoom. Zoom is more of a bearish speculative play here on earnings. We have earnings at the end of the month. And we can see here Zoom's been pretty much on a pretty long-term downtrend here. There's other names that are better than Zoom, which is very ironic considering we're using Zoom right now. I realize the irony, but what we can see here is that price did gap down significantly from the last earnings announcement. It kind of found resistance here at 300, and after moving all the way to around 250, price has bounced back, and it's not bouncing back with strong momentum. This, for me, does not provide evidence of a full-on reversal. And I think it might grind higher to around 300, where it will run into some resistance. And that would provide a very good bearish opportunity, in my opinion. A good risk-reward earnings play on Zoom should Zoom disappoint in earnings. And from there, I do see price maybe declining to around the 240 support level or so. And our last bearish market mover for today is Hershey's. So Hershey's is part of the staples sector, which has been underperforming markets in recent weeks. And we can see here that price has been relatively range bound between 182 and 170 or so. It did try and retested resistance level recently and failed on multiple attempts. Earnings saw a gap lower, a retest intraday, and a rejection intraday. And that, for me, provides quite a lot of evidence here of a break below that 175 level and continuation lower back to 170. Momentum is looking pretty weak here, so I do expect Hershey's to continue lower from current levels. Okay, and with that, that is all I have for you today. Thank you so much for joining me during this session, and I hope you gained some insight as to how we are viewing the current markets. And yeah, I will see you next week, Tuesday. So have a great trading day ahead, and thank you. Bye.